Welcome to today's Explainer. We're jumping right into a really fascinating manifesto by management consultant Hariom Himire. It's all about the evolution of Nepali banking and why the entire sector urgently needs to move way beyond traditional interest spreads. Let's get right into it.
So, what happens when an entire nation's banking engine gets stuck in its comfort zone? Well, to figure out where we're going, we first kind of have to look at where we are. For a long time now, the status quo in Nepali banking has been deeply entrenched in a comfort zone. We're talking a heavy reliance on collateral-backed lending, traditional interest rate spreads, consumer vehicle financing, and risk mitigation that's driven almost entirely by real estate. And look, to be fair, this highly conservative framework actually did its job. It preserved systemic stability during some periods of really intense political volatility. But here's the problem. It's hit its structural limits. We are living in an era of rapid digital disruption, pressing federal development mandates, and, most critically, structural youth underemployment. Sticking with this old mindset doesn't just mean slow growth. It carries a massive opportunity cost. The banks and their regulatory architect, Nepal Roster Bank, just can't afford to act as passive financial intermediaries anymore.
Okay, let's dive into this comparison between traditional lending and active incubation. Historically, credit assessment in Nepal has been entirely post facto and retrospective. Think about it. A bank asks you for 3 years of audited financial statements plus real estate collateral that comfortably exceeds the loan amount. What does that actually do? It systematically locks out the absolute most vibrant, high-potential segment of an emerging economy. The early-stage startups, the tech innovators, the landless micro-entrepreneurs, they're all shut out. To break this cycle, banks need completely new DNA. They have to transition from a retrospective, branch-reliant mindset to an active, venture-building one. Instead of just waiting for fully mature, risk-free businesses to stroll through their branch doors, progressive banks need to actively build them through seed funding and ecosystem creation. Now, what's really interesting about this slide is how it visually maps out this exact pivot. It's the banking, incubation, and growth loop. Instead of the retrospective model we were just talking about, this highlights a proactive venture-building journey. Let's walk through exactly how this life cycle works in practice. It starts right at the idea phase. This is where banks might sponsor hackathons or boot camps just to discover raw talent. Then comes incubation. And here, banks don't just offer money, they provide actual mentoring, office space, and compliance help. They're hand-holding startups through structural corporate governance and tax accounting. This leads directly to graduation, which unlocks cash flow-based seed financing. And finally, scale, where these incubated startups graduate into massive corporate banking and foreign trade accounts. The long-term dividend here is absolutely massive. If a bank incubates a local agro-processing plant or an IT service exporter from day one, who do you think gets their exclusive transaction banking for the next 3 decades? The bank that built them. They are literally creating their own pipeline of prime corporate clients. But fixing the client pipeline is really only half the battle. Because if you do a cursory review of Nepali banks right now, you'll see a very dangerous structural herd mentality. Portfolios are overwhelmingly concentrated in wholesale trade, construction, and consumer retail. This structural homogeneity leaves the entire financial sector incredibly vulnerable to localized asset bubbles, especially in urban real estate. Moving beyond this requires some serious farsightedness. Banks need an aggressive pivot toward asset classes that actually align with Nepal's macroeconomic future. We're talking about heavy investments in green energy infrastructure, financing climate-resilient agriculture value chains, and figuring out how to properly invest in intangible intellectual property. Which brings us to a strategic insight that is basically tailor-made for the boardroom. Listen to this. Compliance-driven lending is a cost center. Strategic diversification is an alpha generator. Right now, the Nepal Roster Bank enforces mandatory lending thresholds for sectors like hydropower and agriculture. But true leadership isn't just checking off a regulatory box. The banks that built internal engineering capabilities to properly evaluate run-of-the-river hydro projects 10 years ago, they are the ones reaping premium corporate yields today. The next frontiers aren't standard loans. They are complex, high-yield arenas, like solar mini-grids and cross-border energy trading finance. Let's move to and see how this builds into expanding knowledge horizons beyond core banking. Executing these ambitious projects requires a complete rewiring of the banks themselves, because traditional banking fluencies, mastering basic credit appraisal or branch operations, they're simply no longer enough. Just take a look at the specific actions required here. Banks actually have to transform into knowledge organizations. For domain verticals, this means intentionally hiring non-bankers onto credit appraisal committees. We're talking agronomists, energy engineers, software architects, and climate risk experts. Why? Because a multidisciplinary credit team can accurately price a borrower's operational risk rather than just glancing at their financial history. By shifting to predictive underwriting and integrating green ESG criteria, the result is structurally lower non-performing loan ratios and unprecedented access to global green funds. Now, while we've talked a ton about massive corporate scaling and infrastructure, we have to shift our focus to the base of the economic pyramid. True financial inclusion demands radical simplicity and micro-embedded finance. Sure, financial inclusion in Nepal has numerically improved thanks to digital wallets, but the true depth of that inclusion is remarkably shallow. For subsistence farmers, daily wage workers, micro-retailers, formal banking still feels distant, intimidating, and way too complex. And here is the paradigm shift. Banking for the lower income bracket is not just corporate social responsibility, it is a vital, high-volume business imperative. And this brilliantly illustrates the solution: micro-embedded financial products. The idea is to seamlessly integrate financial services directly into daily digital workflows via open APIs. Imagine a design where a microinsurance premium for a farmer's livestock isn't a separate, complex bill they have to go pay at a branch. Instead, it's just automatically deducted in tiny increments straight from their milk cooperative payout ledger. It's banking that happens invisibly, right inside the flow of commerce. Democratizing access requires meeting these micro-entrepreneurs entirely on their own terms. It means redesigning digital platforms with radical simplicity. Think voice-activated commands and interfaces using localized Nepali dialects to bridge that digital literacy gap. Think about micro-overdrafts built strictly on mobile wallet transaction histories. This kind of technological innovation bypasses those intimidating branches and mountains of paperwork, allowing a street vendor in Janakpur or a tea shop owner in Pokhara to instantly access the exact capital they need to grow. So the crucial point is, realizing this vision requires immediate coordinated action from the top down. Policymakers at Nepal Rashtra Bank must create regulatory sandboxes so banks can test algorithmic credit scoring while actively incentivizing equity-like structural investments. For bank executives and board members, it demands a bold departure from the old playbook. The race to open identical brick-and-mortar branches just to fight over the same established corporate clients has to end. The focus must entirely shift to blue ocean market creation. Which brings us to our final thought. The choices made in the next decade are absolutely going to define the country's economic future. By embracing entrepreneurial incubation, expanding knowledge, diversifying away from herd mentality asset classes, and truly democratizing access, the banking industry can secure sustainable returns and build a deeply resilient economy. But the big question remains: will Nepal's banking sector remain a cautious custodian of domestic wealth, or will it evolve into a dynamic economic catalyst? The blueprint is right there. The time to build is now. Thanks so much for joining me on this explainer, and keep questioning the status quo.